Welcome back. Today, we're dissecting one of the most ridiculous and contradictory moments in the history of the Nobel Prize in economics. Imagine the Swedish Academy deciding to split the Nobel Peace Prize between a vegan monk and a heavy arms dealer. Sounds insane, right? Well, that's exactly what went down in 2013 when the Nobel Prize in Economics was handed to Eugene Fama, Robert Shiller, and Lars Peter Hansen.
Why was it insane? Because Eugene Fama is the godfather of the efficient market hypothesis, the guy who believes price represents absolute truth and you can't beat the house. Meanwhile, Robert Shiller is the guy hunting for irrationality, the one claiming the market is frequently high as a kite, driven by herd mentality, and that bubbles are totally predictable. And Lars Peter Hansen? He's the grumpy mechanic in the middle, holding a statistical ruler to see who's lying less. They got awarded for the same thing, empirical analysis of asset prices. Basically, the Nobel Committee admitted that financial economics is schizophrenic. We simultaneously believe the market is perfect and that it's a hot mess.
To understand this clusterfuck, I'm taking you to a humid, filthy place full of lies, the Busang jungle in Borneo, Indonesia, mid-90s. This is the stage for the Bre-X mineral scam, a heavyweight example of asset pricing that both Fama and Shiller could use to prove they're right in the most painful way possible.
Bre-X wasn't Enron. It was way worse. Enron at least had nice offices and accounting wizardry. Bre-X was a nobody Canadian mining company trading for pennies. Literally penny stock trash that pros used to line in bird cages. But then, David Walsh, a bankrupt CEO, and John Fellerhoff, a geologist with a rep but no cash, claimed they found the world's largest gold deposit in Busang.
What happened next was asset pricing mechanics running on nitro. Bre-X stock shot from garbage status under $1 to over $280 split adjusted. At its peak, this nobody company was valued at over $6 billion. Massive pension funds like the Ontario Teachers Pension Plan piled in. Analysts from top-tier investment banks like Lehman Brothers, ironically, and JP Morgan slapped strong buy ratings on it. Why? Data. The core samples coming out of Busang showed insanely high gold content.
From Eugene Fama's perspective, the market was being incredibly efficient. The Bre-X price explosion was an instant, accurate reaction to new information, news of a massive gold strike. The market absorbed the info, calculated the reserves, multiplied by the spot price of gold, subtracted extraction costs, and boom, spit out that $280 price tag. Nothing wrong here. Price reflects all public info. If you stood there in 1996 and said Bre-X was a bubble, Fama would tell you to look at the geological reports.
But then, the naked truth started stripping, following a script Robert Shiller would probably smirk at. Michael de Guzman, the chief geologist supervising the samples, suddenly fell out of a helicopter over the Indonesian jungle, ruled as suicide. Days later, an independent audit dropped the bomb. No gold. Zero. The core samples had been salted, dusted with gold shavings from wedding rings or bought from locals.
Bre-X stock crashed to absolute zero overnight. Billions vaporized. Top-tier funds became the punchline of a bad joke. At this point, Shiller walks in and says, see, the market isn't efficient. It's driven by irrational exuberance. Investors didn't verify, they just had FOMO. Prices detached from reality, which was basically zero because of herd mentality.
So who was right, Fama or Shiller? The painful answer is they were both right, and that's the tragedy for your wallet. Fama was right because the market reflected the information, even if the info was fake. Shiller was right because the market bought into a fairy tale without a shred of skepticism. Bre-X is the embodiment of the 2013 Nobel paradox. Asset prices are both a mirror reflecting information and a kaleidoscope of madness.
But wait, we haven't talked about Lars Peter Hansen. If Fama is the architect and Shiller is the shrink, Hansen is the engineer trying to measure how hard the building is shaking before it collapses. Hansen doesn't care about gold dust. He cares about how we know which model is broken. To understand that, we need to leave the jungle and dive into the underground engine of the financial system, where numbers dance not for gold, but for risk.
I'm going to show you how Fama and Shiller's theories collide through the collapse of a giant you might have forgotten, but one that shook Europe to its core, Parmalat, the Italian dairy empire, aka Europe's Enron.
Welcome to Italy, land of the Colosseum, red Ferraris, and Parmalat, a conglomerate that was once national pride before becoming the continent's most embarrassing stain. If you thought the Bre-X gold scam was just some desperate diggers in the jungle, Parmalat proves that even blue-chip corporations, the pillars of the economy, can be zombies wearing expensive makeup. This is where Fama's efficient markets and Shiller's behavioral finance crash into each other like two semi-trucks with cut brake lines.
Rewind to the early 2000s. Parmalat wasn't a penny stock, it was a global dairy empire.
Their milk, yogurt, and juice were in millions of fridges from Europe to South America. Their stock was a staple in safe pension fund portfolios. Callisto Tanzi, the founder, was worshipped as a benevolent godfather of the food industry. Through Eugene Fama's lens, the market was pricing Parmalat with pinpoint accuracy based on financial statements audited by the biggest names like Deloitte and Touche. The stock price was stable, reflecting steady profits and a massive cash pile the company claimed to be sitting on. Fama would say, look, price is the sum of all public info. The reports say they're rich, so the stock says they're rich. The market isn't wrong, the input data is just garbage.
But Robert Shiller would look at the chart and laugh. He'd point out that despite the dreamy financial reports, Parmalat kept issuing bonds to borrow money. Why would a company claiming to have billions in cash need to borrow at high interest rates? It was a logical paradox, but the market ignored it. Why? Because of the narrative. Shiller always emphasizes that investors aren't the cold calculators Fama thinks they are humans, and humans love a good story. The story of an Italian dairy giant conquering the world blinded everyone. Irrational Exuberance made investors ignore the flashing red lights, believing Parmalat was too good to fail.
And here enters Lars Peter Hansen, quiet but brutal. Hansen studies how asset prices move based on macro risk and the stochastic discount factor. In street terms, Hansen tries to measure the true price of risk. In the Parmalat case, the market priced risk disastrously wrong. Standard pricing models failed because they didn't account for the variable of systemic fraud. Hansen gave us statistical tools, GMM, to test if economic models match reality, and in this case, the model snapped in half. The explosion happened in December 2003, and it was stupidly simple. Parmalat claimed they had an account at Bank of America in New York holding nearly 4 billion euros. When auditors finally bothered to pick up the phone and call the US to verify, Bank of America replied, "What account?" Turns out, the document confirming that 4 billion euros was a sheet of paper forged by scanning a logo, printing it out, taping it over fake numbers, and running it through a fax machine a few times to make it look vintage and authentic. A kindergarten-level art project fooled the global financial system for years. 4 billion euros of thin air. The actual debt was 14 billion, 8 times the reported figure.
The moment the truth dropped, Parmalat stock fell off a cliff, losing 97% of its value in days before being delisted. At this point, Fama was right again in the most sarcastic way. As soon as the fake account info became public, the price instantly adjusted to its true value, 0. The market reacted with light-speed efficiency. But Shiller was also right, because the crash proved the previous price was a massive psychological bubble inflated by greed and blindness.
The lesson? Eugene Fama teaches us that price reflects information, but he doesn't guarantee the info is true. Robert Shiller teaches us that the crowd can be hypnotized by a pretty story, ignoring illogical warning signs. And Lars Peter Hansen reminds us that mathematical models, no matter how complex, are useless if we don't understand the nature of the hidden risk.
But Parmalat or Bre-X were just local accidents, malignant tumors in a seemingly healthy body. What happens when an entire country, an entire economic system, turns into a giant casino where madness becomes national policy? To answer this, we won't look at the US or Asia. We're going to a tiny frozen island in the middle of the Atlantic that thought it could turn fishermen into investment bankers overnight.
Welcome to Iceland 2008, where the efficient market theory was abused so hard it held a whole nation hostage. Welcome to Iceland, land of ice, fire, and Bjork. But we aren't here to chase the northern lights. We're here to dissect the scene of the 21st century's weirdest economic crime, where the theories of our 3 Nobel winners collided on a national scale. If Bre-X was petty theft and Parmalat was organized crime, the 2008 Iceland collapse was state-sanctioned mass hysteria, a global glitch that no model predicted.
Picture this, a tiny nation of 320,000 people, roughly the size of a mid-sized neighborhood in a major city, decided that catching cod was so last century. Instead, they wanted to be international financial moguls. Their 3 biggest banks, Kauping, Landsbanki, and Glitner, were privatized and unleashed. The result? In less than 5 years, the total assets of these banks ballooned to 10 times the country's entire GDP. You heard that right, 10x. Imagine if your local credit union had assets 10 times larger than your country's economy. That's the level of risk we're talking about.
Through the lens of Eugene Fama and the efficient market hypothesis, what happened in Iceland from 2003 to 2007 made perfect sense. Why? Because global capital was flooding in via the carry trade. Interest rates in Iceland were sky high, over 15%, while in Japan or Europe they were dirt cheap. Investors, Fama's rational actors, did the math. Borrow cheap in Japan, dump it in Iceland, pocket the difference. The Forex market pushed the krona to the moon because demand crushed supply. Bank stocks soared because their book profits looked gorgeous. The market was accurately reflecting information about cash flow and returns. Fama would nod in approval.
But Robert Shiller would look at Reykjavik and see a giant open-air mental asylum. He'd see fishermen abandoning their nets to take crash courses in derivatives trading. He'd see average Joes taking out loans in Japanese yen or Swiss francs to buy Range Rovers and luxury condos just because the foreign interest rate was lower. This is the textbook definition of irrational exuberance. An entire population got swept up in the mythology of financial Vikings conquering the world. They believed housing prices would go up forever, the krona would stay strong, and the party would never end. Shiller would say asset prices in Iceland had completely detached from productive reality. You can't get rich just by selling debt to each other.
And this is where Lars Peter Hansen steps in with the gravest face in the room. Iceland's problem wasn't just a bubble, it was structural risk. The pricing models used by Icelandic banks and rating agencies like Moody's or S&P made a fatal error Hansen always warned about: false assumptions about liquidity. They borrowed short-term from international markets to lend long-term on risky assets. Their models assumed the capital markets would always be open. But when Lehman Brothers collapsed in September 2008, global capital froze. The stochastic variable in Hansen's equation jumped to max level.
The ending was faster and more brutal than any Hollywood movie. In just 3 days in October 2008, all three major banks collapsed completely. The currency lost 80% of its value overnight. The stock market vaporized 90% of its value. Yes, 90% basically went to zero. McDonald's had to close down because importing a single onion became too expensive. From being some of the richest people on earth, Icelanders woke up drowning in foreign currency debt that now cost them double or triple to repay. Iceland's collapse is the loudest proof of the 2013 Nobel dilemma. The market was efficient at allocating capital to where returns were highest per Fama, but it was simultaneously driven by insane herd mentality per Shiller and finally imploded due to unmeasured systemic risks per Hansen. Three old guys, three theories converging on a frozen island to prove one thing: when greed meets opportunity, humans create financial disasters that no math model can salvage.
So after all these stories about fake gold, phantom milk, and broke Vikings, what should we, the smart skeptics, do with our money? Should we trust the market or trust our own cynicism? The answer isn't in a textbook. It's in the survival strategy I'm about to break down for you.
We've hacked through jungles of fake gold, waded through Italian milk factories built on debt, and watched a frozen island evaporate due to greed. Now it's time to shove the academic theories aside and talk turkey about your wallet. The Nobel Committee giving the prize to Fama, Shiller, and Hansen is like handing you a treasure map torn into 3 pieces, with each piece pointing a different way. You might feel confused, but this is actually a priceless gift, if you know how to tape them together into a battle plan. The first and harshest lesson comes from Eugene Fama. Learn some humility before Mr. Market. Accept the brutal truth that you, a tiny individual with a laptop and spotty Wi-Fi, are not smarter than the massive machine of millions of brains trading every millisecond. Unless you're a politician writing the laws or a CEO cooking the books, that hot tip you read on Reddit or saw on the news, the supercomputers on Wall Street priced that in 3 weeks ago. Don't try to pick individual stocks or day trade with the delusion that you'll beat the market consistently. Long-term, you're just making your broker rich on fees and the IRS rich on taxes. Fama teaches us the market is a grinder that crushes egos, and the best way to win is not to fight it. Buy the whole market via cheap index funds, ETFs, and let time do the heavy lifting. Be lazily smart. However, you must never turn off your Robert Shiller skepticism radar. Fama says price reflects info, but Shiller reminds you the crowd is often smoking something strong. When your Uber driver starts giving you crypto tips, or your unemployed cousin brags about making a year's salary on a meme stock, grab your life jacket. Never buy an asset just because the line is going straight up. Look at the fundamentals. If a soda company has a market cap bigger than a country's GDP, run! Shiller teaches us to be contrarian. Be greedy when others are terrified, like when Iceland collapsed. That was the time to buy assets for pennies. And be terrified when others are greedy, like when Bre-X was flying high on fake drill results. Don't let FOMO turn you into shark bait. True value always returns. The question is, are you sober enough to wait for it?
Finally,
Tattoo Lars Peter Hansen's cold warning about invisible risk onto your brain. Never bet the farm on one horse, and more importantly, don't use leverage like a maniac. Your risk management models, whether run by AI or Excel, will always fail at the most critical moment because they rely on past data. The future is full of deadly, random variables. Always keep a stash of cash, some gold, or anything liquid to keep you alive when the system glitch hits. Hansen reminds us that we can't measure the extent of bad luck or the depth of human stupidity, so always leave yourself an exit. Don't borrow in foreign currency to buy a house like the Icelandic fisherman, because when the tide goes out, you'll be the only one swimming naked.
In short, to survive in this global casino, you need to be financially bipolar. Build a passive, diversified portfolio like Eugene Fama tells you. But keep a cold, cynical eye out for bubbles like Robert Shiller. And always prep for doomsday like Lars Peter Hansen. It's a delicate balance between trusting the system and healthy paranoia. The financial world isn't a place for naive people who believe in get-rich-quick fairy tales, nor is it for arrogant guys who think they're God. It's a gladiator arena. And now, you've got the weapons of 3 of the greatest minds to defend yourself. Good luck, keep your wallet tight, and don't get fooled by gold mines that don't exist.